It's probably time for us to make a start. So, good afternoon and welcome to the K3 Hub presentation today following the autumn budget announcement last week. My name is Kelly Mitchell. I'm an insolvency practitioner and a managing director in Quantuma. And today I'll be chairing this webinar. The format for today's session is going to be a 45-minute presentation from our keynote speaker. And then we're going to have a Q&A session for around 30 minutes with our panel of experts. So just by way of background, for those of you who don't know, the K3 Hub was launched in 2021, and we're proud to have over 3,500 members today. The Hub offers a range of CPD and training sessions like the one we're going to enjoy today. And there's referral fees that are paid for certain types of work that are referred to in the group. There is a slide on the screen right now that sort of summarises the services that we offer across the group, and you're welcome to contact us at any time to discuss this further. So just in terms of a few housekeeping points, we are recording today's session. The slides won't be circulated after the session, but we will be putting the recording on both the K3 Hub website and on the Quantuma websites. Please do feel free to ask questions as we go along. If you could please use the Q&A option at the bottom of the screen with the question mark as opposed to the chat, it will just make it easier for us to sort of monitor those questions. And if you ask questions as we go through Jeremy's presentation, if you give some context as to what you're asking about, that would help us at the end of the session recall what you were referring to at that point. We'll do our best to try and answer all the questions. So far, we've got 248 guests on this webinar, so we might not be able to get through all of them today, but we'll certainly follow up with those separately. What we're also going to be doing is running some short polls. So Jeremy runs some polls throughout the presentation. Your answers will be anonymous. Please take part. It's just for a bit of fun. There's no prizes or any disparaging comments if you get it wrong. It's just a bit of fun to keep it sort of entertaining. So, with that in mind, I'm delighted to introduce our speaker, Jeremy Mindell. I'm sure many of you have heard from Jeremy before, but for those that you don't, Jeremy's been delivering our budget briefings for many, many years. Absolute expert, both in person and online. He's also been lecturing in tax over 20 years and is an accomplished speaker. Amongst other things, he covers issues relating to tax, pensions, share schemes, and remuneration. So, over to you, Jeremy.
Thank you very much, Kelly. So, on the this webinar, I've got 45 minutes to look at various elements of the budget. And of course, there was a lot more technical detail. You could have a presentation lasting 3 hours, and it probably won't cover all the details because, as Rachel Reeves or the commentator said, there was a smorgasbord of little tax changes or bigger tax changes, but not the big one, not the increase in income tax rates that had been widely floated before the budget. And that has caused some issues that you might have seen over the weekend. When did they decide in favour? When did they decide against? And when did they get the various different forecast from the Office for Budget Responsibility? And did the government know about the better financial position before it went on air, trying to roll the pitch on that infamous breakfast broadcast? With that in mind, my first poll on this basis is on a scale of 1 to 10, with 1 being dissatisfied and 10 being satisfied. Do you think Rachel Reeves has been a success as Chancellor of the Exchequer? So please vote now. In the interest of time, you don't get a great deal of time to vote, but decide. 10 is very satisfied, 1 is very dissatisfied. Where do you sit on that? Okay, let's see. Oh gosh. Almost everybody very like the face-to-face, not quite the same, but almost everyone is in either the extremely dissatisfied 1 or the 2, and the 3 also very dissatisfied. Very few people on the other side I only have one person who says that they're extremely satisfied. And if I look at all the others, so if I look from the very satisfied onwards, it really is a relatively small percentage. We're not looking the more than 10% who are actually satisfied with her performance. Perhaps not completely surprising on that basis. Um, so let's move on. Let's move to the background. So the background of this was really set, and one of the reasons I think that we've had so much speculation on this budget was because a lot of people looked at the next budget from at least the spring statement, or indeed from the October budget in 2024. Because what did she do in 2024? She loosened the financing rules. Taxes were raised by about 40 billion. She was able to raise spending by 70 billion on that basis. And then the issue, which I think has come home to roost, where the chickens have really come home to roost, is the fiscal headroom that she set was below 10 billion. So in other words, if something went wrong or we suddenly needed to spend more money, then actually in order to keep within her budget, her fiscal rules, she had less than 10 billion pounds to play with. The other element was about credibility. So at the CBI conference in November 2024, after businesses complained vociferously about the employer NI increase, along with the increases in minimum wage and the employment rights bill, she said at the CBI conference, I am not coming back for more. The tax rise was a one-off. However, in the spring statement, there was a downgrade in growth, and it was felt that the headroom disappeared, which is why we've had months of speculation about what she would do. And this is not just from, if you like, the right-wing press. This is the New Statesman, which is a weekly magazine generally on the left of British political opinion, not the hard left, but a soft left opinion. Almost exactly a week ago, year ago, Rachel Reeves told the CBI she was not coming back with more borrowing and more taxes. It was a desperate attempt to appease businesses aggrieved by the rise in national insurance. But even at the time, plenty in Labour questioned whether Reeves would be able to keep her word. She is not. And if you look at some of the issues, what they looked at is what they call post-traumatic stress disorder from the last budget. Business leaders warned that they were suffering PTSD from the last year's tax raid, as the survey laid bare the state of paralysis across corporate Britain. A closely watched survey showed confidence amongst retailers sank at the steepest pace since the global financial crisis in anticipation of another tax raid. And sentiment in the high street has dropped and has remained very low. And sales are plunging at the moment, or certainly were plunging in October and November, on the basis of consumer confidence, or the lack of it, affecting what people would do to buy. I was in a market town over the weekend, and it was noticeable that High Street was a lot quieter than you'd expect with only, four shopping Saturdays and Sundays until Christmas. It then became a sort of open season with Labour MPs defeat the welfare reforms due to save £5 billion. That was a defeat in July. The two-child benefit cap. So the government was, until very recently, defending the maintenance of the cap and had even withdrawn the whip from MPs who'd voted to get rid of it. And then they decided to do a U-turn. Speculation for the November budget starts early, and because it was done on the 26th of November, it really allowed, this speculation to go and rise and rise. Government approval down to 15%, and Reeves and Starmer's even lower. If you look at the figures for the fiscal headroom, and Rachel Reeves has now said she's got fiscal headroom of about 22 billion, you'll notice that is slightly a smidgen below what the average fiscal headroom has been since 2010. But what you can see is that that headroom has been, over the past 3 years, driven lower and lower. And I think one of the issues, as I said, was, well, if your forecasts aren't right, if the economy doesn't grow, if we get more spending for whatever reason, then you end up breaking your rules. But actually, instead of the sort of 20 to 30 billion, I saw reports of potentially 50 billion of a black hole. The gap was at one point only was actually negative, that there wasn't a gap. It was 4.2 billion pounds worth of surplus. Indeed, even with a surplus of 4.2 billion, at the very most, you only needed 6 billion of rises in order to possibly appease the bond market. The rest was voluntary. And according to the OBR, because of increased inflation and increased wages, which with fiscal drag, i.e., the fact that allowances are not going up with inflation, so people are paying more of their higher salaries in taxes and national insurance, there was a surplus of 4.2 billion, according to the OBR. And I expect with the chair of the OBR, Richard Hughes, appearing this week at the Treasury Select Committee, that there will be more fireworks this week. This is the next opinion poll question. Give you a few seconds to vote on that. Okay, let's see the results. Ooh. Interesting, nobody puts it down to Trump tariffs. 20% to Brexit, a higher, slightly higher figure to the Labour government, which are probably mix with the high taxes, smallish percentage for previous Conservative government, and reasonably high figures for the aftermath of COVID, not surprising, and weak UK productivity, which I think has been a major issue on that basis. But you could see that this would be a concern in terms of if you add the high taxes and the Labour government together, that outpaces everybody else. The other area which Rachel Reeves needs to deal with, apart from her backbenchers, is of course the bond market. Famously said, somebody said they'd like to come back if they died and came back as the bond market, because they can then really rule almost all governments. And the Labour MP's rebellion over the government's welfare bill in July was further evidence for the market. When you've got a 168 majority and you can't get through some welfare spending cuts, one city strategist told me, the markets have concluded there's not a cat in hell's chance of bringing the fiscal side back. They pointed to the UK's 1.4 trillion in public sector pension liabilities and the explosion in disability benefits, where actually, rather surprisingly, well, certainly given previous comments, they've actually made it easier to access certain disability benefits that was hidden in the budget statements as well, as factors that would prevent investors from buying Britain's debt. The bond vigilantes aren't stupid, they told me. They're looking at this and saying, if your 405 MPs aren't willing to tackle this, then there's no hope for you. And I think that so far that's been, the bond markets have been relatively stable, although I have not looked at them this morning. If I look at the tax rises and falls during the decade, if I look at who did the biggest falls, so there's Barber, Lawson, and after Sir Geoffrey Howe raised taxes in 1981 in similar tactics to Rachel Reeves, they then dropped. Even the late great Dennis Healey, who raised taxes very substantially at the beginning of his term of office, then after the government had to go to the IMF for a bailout, reduced both taxes and public spending substantially. Both Lamont then increased taxes, and then so did George Osborne in the aftermath of the fiscal crisis of about 2010. On that basis, you may recall the previous Treasury Secretary who said, "Oh, I'm sorry, there's no money left in 2010. Financial crash had created a yawning public deficit." But if you look at Rachel Reeves, and that was before this budget, you were looking at 40 billion, you add another 30, and Rachel Reeves' tax rises at today's prices when compared with other chancellors are the biggest in the post-war period. And it's fair to say that, a bit like you, although they've had less choices, and there they got more than one vote, but Starmer and Reeves, even before this budget, were seen as generally the authors of some of the difficulties that the economy has. And what Reeves has said is that she will sort out Britain's fiscal position for good. That will be the rationale for the increasingly inevitable rise in income tax rates. Well, that was before she then did a further U-turn. That is what she told us last year. It was going to be a one-off, but it wasn't. She's coming back this year to raise taxes by nearly as much as she did last year, by about around 26 billion. Nothing about today's speech that provides any confidence that she, or more likely her successor, will not be back next year too. The problem is that, having retreated on modest cuts to welfare spending in the summer, the government has made it all but impossible to get any further spending cuts past backbenchers. Further borrowing has pretty well been ruled out, not so much by Reeves as by the markets. Reeves is thus trying to play a round of golf with just one club: tax rises. We still have in the UK the highest inflation in the G7, not helped by the rises last year, which fed into inflation as employers passed through the costs. It will come down, but it's not coming down as fast as it might. And then on the economy, that has certainly led to this huge slump from Labour being seen as being trusted by about a third of the populace as the best on the economy, to 12%, and that was before the budget. If we look at not just the general public's opinion, which may not be as important, at least 3 years possibly to a general election, but if we look at the bond market, we have the highest borrowing costs in the G7. And that's interesting because our debt is not the highest, our debt to GDP is not the highest, but we still have the highest borrowing costs, which reflects productivity. And it's interesting that the infamous Liz Truss quasi-Kwarteng budget only got gilt yields to about 4.75%. We're now well past 5% and potentially climbing later this year, which is not a good sign on that basis. Sickness benefit is still increasing and no signs of that. That is what is projected for the next few years. And actually that benefit has increased based on the budget we've just had, because they have put another 16 billion into welfare. The area that's a real problem, and this is certainly not just the problem of the previous government, as I indicated, from 2008 with the crash, we are looking at pretty sickly productivity. And if we're not increasing productivity, and that has been downgraded yet again, if productivity is not going up, how on earth can we afford to pay ourselves more if we are not more productive? And in certain cases, that's not a question of working harder, it's working smarter or using better technology on that basis. My next question is, how many parliaments do you think Labour will last? A moment to think. That is not, that's more of a fiscal question that I'm looking at. Okay, let's see the results. Oh, one parliament. 86% said one parliament. And the point that I would make is, if you think Labour's only going to last one parliament, why get so worried about inheritance tax or even capital gains tax? On the basis that what is pretty clear is that if you believe that Labour is going to last one parliament and potentially be replaced by a more right-wing government, what do right-wing governments do? They generally reduce capital taxes, inheritance tax, or capital gains tax. So unless you are either planning to sell your business in the next 3 years, or indeed think you're going to die in the next 3 years, then possibly your best tactic is to just hang on in there. Because if you believe that there may well be a change of government, why take irreversible measures which may have other side effects, giving assets away, for example, and using the 7-year transfer? Why are you worried about that if you think that the government's not going to last? On the basis that both Conservatives and Reform have both made it clear that they would be looking to get rid of agricultural property relief and probably business property relief. Sorry, not get rid of them, but reinstate them, I should say. Reinstate them to their full value. So if you're a 30-year-old farmer, what are you worried about? The same would be with a business. If you're not looking to sell it or bequeath it in the next few years, what are you concerned? Should you be taking hasty action now, which may be irreversible? One of the other areas which any government will need to look at some point, in my opinion, would be public sector productivity, which is sagging. So the headcount goes up on the public sector remorselessly. So some of that was based on COVID. And during the COVID period, obviously, productivity went down. But unlike in the private sector, where it recovered to its pre-COVID levels, in the public sector, as they've recruited more people, the productivity has gone down, not up. And sooner or later, someone, if they're really going to be looking at actually dealing with public spending, is going to have to change this. And you may have views about who might be able to do it and who certainly isn't able to. So the other element, particularly with productivity sinking, is very much, you could have had a conversation of Keir, I shrunk the economy, because one of the major headlines was the OBR downgrading growth to 1.5%, and indeed indicating, based on current government policies, that the UK economy was simply unable to grow by much more. So if you pump more into the UK economy, you won't get growth, you'll get shortages and probably inflation. So all the indicators flashing red, because you've got inflation, unemployment, and public borrowing all going up. And you've got going down growth, sterling, confidence in many surveys, but including the Purchasers Managers Index, the PMI index. And if that is happening, that is not a good outlook for the economy. Have a look at another survey. This is by the Institute of Directors, which has seen an incredible crash in business confidence. And so therefore, the outlook, if people feel that there's no point investing, put it saving, starting a new business, working harder, then that will have an effect on economic output. However, the OBR added to the deficit projections due to the lack of productivity growth in the economy, but not as much as I predicted. And then this current issue is this, because inflation is higher. That's not necessarily a great thing. What they're saying is the government tax take through fiscal drag is greater. And that's where the controversy has happened. You can see the picture in yellow was the March 2025 forecast. The November one has downgraded growth, right? Slightly higher for 24, a bit higher for 25, which is something that the Chancellor's talked about, obviously stressed, but has said, oh dear, growth for the next few years is really struggling even to make 1.5%. The story that I thought was going to get lost in the noise, but has really blown up over the weekend, is the pre-budget briefing on Reeves' decision not to break the manifesto pledge on income tax. The OBR shot down suggestions that plans to increase income tax would drop because of improved forecasting. It notes that the final pre-measures fiscal forecast incorporating these later interest rate assumptions was finalised on the 30th of October and sent to the Chancellor the following day on the 31st of October. No further adjustments were made to our economy or fiscal forecasts after this. And the OBR published on the Friday an exchange of communications to say when Rachel Reeves did the breakfast presentation on the 4th of November, she already had our forecast saying there wasn't a black hole. Inflation is revised up. The OBR says greater domestically generated inflation alongside food prices mean we expect inflation to stay higher for longer than they did in March. Inflation, they said, would be 3.5% this year, 2.5% next year, and that's higher than they expected in the spring's budget. So the OBR's verdict is clear. Reeves has made the cost of living worse. Price rises will not return to the Bank of England's 2% target until 2027, a whole year later than had been forecast. But obviously, from the point of view of public finances, if we all get pay rises to reflect inflation, if prices go up, the government gets more VAT, and obviously inflation is up, we're all paying more tax and national insurance. The gilt yields so far relatively stable. They've not gone up as much as people thought, but I say I haven't looked at them this morning. And then the other element that she did was the minimum wage going up, which even the Resolution Foundation, and considering the links between the Resolution Foundation and a core of Labour policies, in particular, because Torsten Bell, who was the previous head of the Resolution Foundation, is now Treasury Minister. They said, warned that the 8.5% increase in 18 to 20-year-olds will make it harder for young people to find work. Nye Comenetti at the Resolution Foundation said the measures risk pushing the number of young people not learning or earning closer to 1 million. If they stop firms hiring, then actually people are not getting a pay rise, they're getting no pay at all. So I think that's the element, one of the other elements that is upsetting industry. The other element there, Graham Stringer, well-respected Labour MP for Middleton, said it seems to be for the Labour Party, not the country, which would do nothing to reduce the welfare bill. He said, actually, it's increasing it. And Graham Stringer said Ms. Reeves' decision to scrap the two-child benefit, move supported by Labour voters, showed that she capitulated to party members. And she said that Ms. Reeves had failed to grasp the nettle on welfare savings, particularly the fraud and fiddling of the system. Now, there are other views that say, actually, this is a good move to get rid of child poverty. I'm not here to agree or disagree with it on that basis. But let me give you some of the details in the rest of the time that I have. And if I was advising on tax, what I would say is there were a lot of rumours before the first budget, And the rumours in the first budget, a lot of them didn't happen. And you thought, well, maybe it's the pepper pod or muck spread approach. If I don't, if I spread lots of rumours of nasty things and only some of them happen, people will be relieved. So if you look at it, the dogs that did not bite last time, fuel duty, well, that's going up in September. Mansion tax, that's going to be introduced, albeit in a few years. Income tax threshold extension of freezes. She'd said last time that she wasn't extending the freezes past the Jeremy Hunt proposal of ending them in 2028. Well, now they're going on, I think, till 2031. Dividend tax rises, lots of rumours, didn't happen last time, does happen this time. Employer national insurance on company pension contributions. Well, there's this attack on salary sacrifice, which happened this time, not last time. ISAs, 12,000 limit on cash ISAs, VCT cut to 20% income tax relief than before. And then the dogs that did not bite, tax rises postponed. So there's the 25% pension lump sum, tax free, the pension annual allowance, EIS, SEIS restrictions, potentially exempt transfer restrictions, and the ability to, if you have surplus income, to give it away without getting into the IHT net. So if I have income of, I don't know, 200,000 and I have expenditure, including tax of 150,000, I should be able to give away the 50,000 without it actually being a potentially exempt transfer. I don't have to live 7 years. That wasn't touched either. But you do wonder that given the track record of various things floated for October last year, which resurfaced this year, what might surface next year? And the other element is some of the changes have been staged. So some happened on budget day, some are due in April 27, some in 28, some in 29, and some of them even in 2030, which is beyond the life of this parliament. So an interesting element there. But there were significant measures in this budget in terms of anti-avoidance rules, capital gains tax, which I'll talk about, non-resident capital gains, capping inheritance tax charges for former non-UK domicile residences, some administrative changes to creative reliefs, further amendments to multinational top-up tax, IHT and effective blood compensation payments, IHT anti-avoidance, oil and gas taxation, residence-based tax regime, and tobacco duty rates. And some of them actually happen pretty much either the day or the day before the budget. And then the other big change, mileage charge for electric vehicles from 2028. Fully electric cars charged at 3p per mile, plug-in hybrids charged at 1.5p per mile. The total tax hikes were 26 billion, which takes tax as a proportion of GDP to 38%, which is a record in peacetime. Freezing income tax thresholds, bringing around 8 billion, tax on electric vehicles, and that raid on pension contribution. The mansion tax will be based on property values above 2 million, so very much concentrated in London and the southeast. NIC on employers' pension contributions above 2,000 if they're within a salary sacrifice arrangement. And as I say, the increase in tax on dividends and fuel duty. As I say, the PA personal allowance frozen until 5th of April 2031 at 12,570, and the basic higher and top rate bands frozen until 5th of April 2031 as well. And that is due to bring in more money, but that is over 2 years after the next parliament. And you do wonder whether some of these figures are put in to make the projections of her hitting her fiscal rule work, even if this is well past the parliament, which is due to end in 2029. In terms of the rates of income tax, 26-27 dividend income will go up to 10.75%, so a 2% increase. An increase in the higher rate to 35.75%. And what that does is, of course, make incorporating a business and running it through a company less tax efficient than it was before. The interesting element is she's not changed the 39.35% for additional rate. That remains at 39.35%. And partly I think that is because if you do the mathematics and the calculations on that, that actually it is already taking a very substantial proportion of the company has to pay profits. You pay dividends out of those tax profits. This is coming to a very high rate. And it's generally better to take salary as an additional rate than it is dividends. And that would have been accentuated had it not been for that she froze that. From 27.28, so notice this, a further year grace, 2% extra on the basic rate for property income, 2% for higher rate, and here at 2% for additional rate. And the same will be true for savings income. And somebody said, well, why don't you just put national insurance on it? Well, I think that would have been administratively considerably more difficult, which is why she's gone for this different rate of income tax on that basis. With these different rates between different elements of income, she's now put in a way of working out how what you set your personal allowance and get. But probably the most important element is that you set your personal allowance against, generally speaking, the lower taxed elements, not the higher taxed elements. Our Mansfield tax, so extra council tax on high value dwellings. So there is this called mansion tax, properties worth 2 million to 2.5 million, 2,500. Properties worth more than 5 million, £7,500. A sliding scale for properties worth above 2.5 million, but less than 5 million. Now, the interesting element there is not only is it based in London and the Southeast, but if she doesn't redistribute the money, if the money went straight to the councils, then it would be generally conservative councils like Kensington and Chelsea that would benefit from the extra money. I don't think Rachel Reeves is in the business of giving extra money to conservative councils, so I suspect that this money will be redistributed to other councils. One piece of good news, the EMI changes from 6th of April 2026. Eligibility limits up to 500 employees. Gross assets test is quadrupling to 120 million. Maximum value of options outstanding increased to 6 million from 3 million. Maximum holding period increased to 15 years from 10. And you don't need to notify the notification period to be abolished from April 2027. Now, as I said beforehand with EMIs, they were really for smaller companies. Now you're definitely looking at the medium-sized companies. And they are the most generous form of share scheme relief there is available, apart from possibly the share incentive plan. But the share incentive plan does not compete in the quantum. Here we're talking about substantial. You could give one person options at the grant value of £250,000. So I expect more companies will be looking at EMI plans. VCT and EIS changes, so venture capital trust where you invest in a company which invests in smaller companies. What we're looking at there, up to 10 million, 20 million for knowledge intensive companies. Lifetime company investment limits increased to 24 for 24 million. 40 million for knowledge intensive companies where you're at the cutting edge of research, and gross assets limits up to 30 million before the share issue, 35 million after. The sting in the tails for VCTs as opposed to EIS, Enterprise Investment Scheme, you invest in a share directly. With VCT, it's in a company. That income tax relief is being reduced from 30 to 20%. Let me have a look at the questions and the chat. So, questions. Um, so Brian's question um, uh, it is more of a statement on the basis that yes, seems to have moved from focusing on investment in wealth to redistribution. That is certainly how the budget is looked at the moment by both economists of right and left. You're exactly right, Brian. Um, it will be interesting to see. There are some productivity elements, but not in the tax system. So people talking about making it easier to do infrastructure and, ensuring that like Hinkley Point C is not stopped or made more expensive by a fish disco, that saves the life of one fish a year and costing £700 million, or the bat shed for HS2, which is costing £100 million and may not save many bats. So I think that where they're looking at growth, that would be the element that they would potentially say is going to do this. Alison's asked EMI, Enterprise Management Incentive Scheme. It's a share scheme. You grant options in small and now medium-sized companies, and those options on that basis potentially, or if you grant them a market value, the gain would not be subject to income tax or national insurance, and potentially gives you a substantial saving on that basis. And then the final question from Philip, will wording in advance clearance applications for share reorganisations need to incorporate tax advantage condition? Potentially it will, yes.
Thank you, Jeremy. Is that towards the end of your presentation? So shall we move to the sort of formal Q&A? Of
Can I give 1 minute
course.
on
Yeah.
two other
Carry on.
things? Thank you. I wanted to talk about employment expenses because it's going to be widely looked at. Removing ability for employees to claim deduction of non-reimbursed home working expenses from 6th of April 2026. But the reimbursement of eye test, home working equipment, and flu vaccination costs, not COVID ones, tax-free from 6th of April 2026. The other element that I would mention is that the relief of £6 working from home disappears unless paid by the employer. So that is going to be I would say, a major talking point there, reducing the ability of employees to claim money back from home for working from home. The only other element I would like to mention, or two other very brief points to mention. One is in terms of payrolling benefits pushed back to 2027, and the employee ownership trust. So where you sold into an employee ownership trust, you would get potentially 100% capital gains tax relief. From budget day, that was reduced to 50%. And then the final element I would like to just briefly mention is this, which is, if you like, the most scary element, in my view. Spending soon, tax later. If you look at the blue line, that is spending according to the sources of the OBR reproduced by the Spectator. If you look at the tax element, what you can see with the tax element is it's very much end loaded to the end of this parliament, when presumably at an election that is not going to be popular. And therefore, on that basis, you're going to have that issue about credibility. And I would look at the gap at the end, where spending is supposed to be stable and taxes are supposed to go up. Will the markets really believe in a few months' time that a government which probably wants to get re-elected is really going to increase taxes so sharply, so close to a general election? And of course, you've then got some others which are penciled in for after the general election. In my view, that's the biggest unanswered question. And I'm very happy to take questions on anything after that. Thank you very much.
Thanks, Jeremy. That was really interesting, and I think we all got an agreement with you that there was not exactly a great budget we received last week, and a potentially worst ever, actually, from I think the general discussion we've had over the weekend. Um, so we're now going to move across to the sort of the formal Q&A session. So I'd like to introduce our panelists. We have Holly Bedford, who is a managing director at one of K3's, one of our sister companies, part of the K3 group. It's the K3 Tax Advisory. Then we have Ian Barton, who's part of Quantuma's corporate finance team and heads up that team for us there. And then we also have Marcus Pilkington from Pareto, hope I've pronounced that correctly, who is a chartered financial planner. So, thank you everyone for joining us today. So we'll just start with some of the questions that have been coming through, and the first one's actually for me. So, how did the employment tax increase last year impact on businesses? So, obviously, as an insolvency practitioner, I'm dealing with business failures. Corporate insolvencies are 17% higher in October 25 compared to October 24. And the sectors, that's 30% of the corporate insolvency are in the retail, hospitality sort of sectors, which obviously employ a large volume of minimum wage workers. So I think from my perspective, the employment tax increases have been disastrous and sent a lot of businesses either into insolvency, or I think there's a number of people who are employing less, sort of working with a reduced staff base. I mean, if you've got any opinion on that at all, Holly, from a tax perspective, from what you're seeing?
So I've heard a lot of complaining, obviously, about
Yeah.
the cost of employing people. And I think the the trouble is the pension salary sacrifice restriction that they're announcing, although it's not going to come in for, what, 3 years yet. Employers have used that to help slightly manage employers' national insurance because pensions paid through sacrifice decreased employment income that was subject to NIC.
Yeah.
Employees get a bit of a benefit. The employees get employers get a much bigger benefit. It's just another hit. It's another, increase to the employer's NIC cost for businesses.
And just sort of, while we're on the pension subject, someone just put something in the chat here that says, a question for Ian. Actually, I can't find the chat, 2 seconds. Oh, Holly, any confirmation on EOT payment? And we're sort of skipping ahead now. Let's go back to the pension question. Ian, do you think HMRC will push back pension and IHT rules?
I don't think they'll do very much on the IHT. I think they've probably weathered that storm since last year, the announcements that were made. I mean, the interesting thing about that was there's a lot of publicity on that around impact on family farms, but of course it impacts family business. So anybody who is intending or is intending to pass their business down to their children or other family members will be impacted by that IHT charge on their own death. And these are costs that need to be funded somehow. And I think the sourcing of capital to pay those taxes, whilst there's sort of well publicized deferral schemes and things like that, it's still a cost that's going to need to be met. And on top of all the other costs, as you've just talked about, Kelly, in terms of costs that businesses are having to source funding for through new taxes, if you are anticipating in the next few years that you might have an IHT charge, and taking into account Jeremy's comment about the confidence of those people on this call about how long Labour may last. But the chances are that those policies might take some time to unwind, and the cost of having to pay out that amount of IHT is going to be quite painful on certain family businesses. So I don't think they'll do that. The pension one is almost so far in the future that anything could frankly happen. I mean, things get unwound over a course of weeks. 3 years is well, as they used to say, a week is a long time in politics. 3 years is a very, very long time in politics. And coming just before an election, it'll be anyone's guess whether that one continues or is modified marginally depending on how the economy is doing at the time.
Okay,
Uh,
and
can
sorry.
I just comment on that? Is that if in 2007 to 10, the Conservatives and Labour were competing about what they could do for IHT. So the Conservatives came in with this pledge: you can inherit 1 million without any IHT, and that was achieved eventually in 2021. Labour came in and actually did reduce the impact of IHT for some people by creating the transferable nil rate ban. I don't foresee it as impossible that in the run-up to election that both parties unveil, and Reform, of course, unveil uh, uh, policies which may reduce IHT, because it's not a popular tax. But it doesn't raise so much that it actually ruins the public finances if you got modified it substantially, which is why I think if I was that worried about it, I might be taking out a life insurance policy for 3 years on that basis. I don't know what the financial planner would think about that, but maybe I'd take out a term assurance covering the IHT for 3 years.
Yeah, I mean, as you say, the life policy route for many has become perhaps the easiest way to satisfy any liability. Obviously, with the business property relief coming in next year, and then the year after for that is pensions. And a lot of people, even with quite substantial pension funds, got some clients, 2, 3, £4 million in pensions, whose view is that the government will change many times before they actually pass away. So is it an immediate issue? Maybe not. But it's one of the simplest forms and one of the simplest ways to mitigate the liability, because a lot of people simply don't like to give away large amounts of assets too soon. The establishment of a life policy is seen. We've had a lot of interest in it in the past 9 to 12 months, where it's previously not really been a concern for many people.
So, Marcus, while we're sort of on the subject of IHT, so you're obviously working with a lot of business owners, and what are they doing at the moment with regards to planning and families looking to sell businesses, or are they doing something different with cash assets? What's sort of the general the flow at the moment?
I mean, obviously, one of the surprises that came out was the changes to the EOTs and the tax of those, which came in overnight. And I had one client who was looking to sell a business, and he's actually dragged out the process of going down the EOT route, changed overnight, and it's increased his tax liability on that by about £1.8 million, something that we just weren't expecting. So again, with business owners, it's one of those whereby they've got a substantial probably business asset, and a couple of years ago they looked at their IHT liability and it was probably minimal. They had a business that probably fell under the 10 million value. They had a pension fund and they were doing all the right things, and then suddenly a couple of years later, by April 2027, both of those assets are pulled in. Obviously, there's a slightly lower marginal rate on the business rules, but as we were just talking about those, then people were looking at going down the EOT route, or they're looking at gifting shares to family members, and you can obviously potentially cover that liability through some insurance if you're concerned about living for the 7 years. But a lot of people have started to extract money out and maybe spend that money. We're looking at life policies for clients as well. And people are still funding pensions. It's still a tax efficient way to get money out of your business. But again, there's quite a lot to take in terms of what's happened recently. But there's a number of different opportunities there for people to try and mitigate that liability.
Okay. So, sort of looking at the sort of state of the economy at the moment, we sort of touched on, or I've touched on the fact that insolvencies are through the roof, keeping me very, very busy, unfortunately. But how's that looking for you, Ian, in corporate finance in terms of the deals market when business confidence is so low at the moment?
Yeah, I mean the market's been relatively soft and flat for the last 2 or 3 years. If you look at sort of deal stats between 24, 25, and even 23, they were pretty modest compared certainly to pre-COVID levels. So there hasn't been that ramp up of improvement. If we just looking at us as a group, as the K3 Capital Group, we're actually up 14% in terms of numbers of deals done in quarters 1 to 3. That's not replicated by the rest of the market, to be fair. So we did around 250 deals in that first 3 quarters. I think it's fair to say, in comparing like with like, it will be interesting to see what the end of year position is, because if everybody remembers, there was huge rumours around changes to CGT, which of course there were changes that came in
Yeah.
the last budget, and that caused a real spike of activity in the run up to the October budget last year. So I think it'd be fair to look at what looks like after that. But I would say it is very much a buyer's market at the moment. Still, deals are still getting done. I always look at the world of private equity as a decent barometer on how the deals market looks, because private equity are there to buy and sell and invest in businesses, and they are big on investing and buying at the moment. They see it as a buyer's market. They're not selling too many because they recognise that prices are a bit dampened down because of the issues of business confidence, as you say, and a lot of that. I mean, for me, that was the big message out of the budget, really, that sort of absence of confidence coming through. Just the delay in having the budget at the end of November created a vacuum for people
Yeah.
to fill with information. And Jeremy's already talked about those issues of speculation and sort of rolling the pitch. There was no real mention in the budget of growth initiatives. Growth has flatlined, as we saw on that chart, which probably means nobody really knows what's going on, but it's lower than it was the last time, and lower again than the time before. So that's not overly confident. Um, and there seems to be an increasing sort of actively targeting businesses to pay higher levels of tax. We saw employers NI last year, and once again that sort of those taxes that are just creeping into business. Um, and just that whole debate over the weekend about the headroom and everything else, it just goes to show that there's a real lack of confidence, and a lack of people do deals when they're confident about what's going on in the future. They make investment, they buy businesses, they grow businesses, they hire staff. That absence of confidence, I think, is the real message or non-message that came out of the budget for me.
Yeah, no, absolutely. And obviously, minimum wage is about to go up again, and obviously the associated costs of pension and NI that comes with that. So this is an open question. I don't know who wants to take this one, but what are your views on freezing the tax bands? Is that a more effective way of increasing
Happy
the
to
tax
answer.
revenue, or would it be better just to increase the basic rate of tax?
I think that there's always that discussion. It comes up all the time. It was interesting. I was rereading Nigel Lawson's memoirs, and he inherited a relatively stable position, and he discussed it and decided I should raise the thresholds because they'd been effectively cut before by because of inflation, and inflation was much higher in the 80s, and he decided to restore the thresholds by increasing them, and then he reduced income tax substantially in his last in two of his last three budgets. I think that there are differing elements. I mean, I would be in favour of freezing thresholds if I have to raise taxes, and I wouldn't say I was necessarily in favour of that the government needs more tax. But if it does, then I would freeze thresholds, because I think that there's an issue about it does have different effects. If you say to people, if you keep on increasing the rates of tax, you have a situation where people say, well, why bother working harder? And you think about the marginal rate of tax. So you've got your 20% basic rate, you've got your 8% national insurance, and then if you're a student, you've got another 9% potentially of student rate, and the threshold's not being increased on that. So that takes you to what? 37%. You're paying on pension, what, 3-4% under auto enrollment, taking you to 41% on relatively modest earnings. And the same is true in terms of the higher rate taxpayer, particularly if they end up losing child benefit between 60 and 80,000, or people who, between 100 and 124 125,140, you're actually at a 60% rate because of the reduction in allowances. I do think for health of the economy, it's important to look that your marginal rates of tax are not so high that they stop people doing things for their economic benefit. So if you've got to raise it, I think the fact that you can earn £1,000 tax and NI free, or a bit over that, every month, I think is not an unreasonable positioning, in my view. But a lot of people have a different view. I think you should focus on the marginal rate. If I work a bit harder and I get money because I decide to do overtime or extra work, how much of that money am I actually keeping?
Yeah, it's a big issue. Big issue. So probably this is a question for Marcus. So obviously there's been changes to the dividend tax rates on dividends.
Yeah.
What are your views on this? Do you think that's just discouraging entrepreneurship, or do you think it's actually fair that people with a limited company income should pay the same as sort of PAYE or closer to?
Yeah, it's an interesting one, isn't it? Because dividend rates, obviously, a lot of business owners that have drawing income, and it's always generally, not always, but up to the 50,000 threshold. So they've previously been paying 8.75, obviously, a 2% increase on that. I guess some people will look at it in terms of, well, actually, they're still paying less marginal rates than you or I are. And even at the higher rate, and they've obviously not increased the additional rate, as was mentioned before. But generally, you won't see any business owners drawing significant amounts out for tax reasons. So I guess all in all, from a corporate business owner point of view, it is a relatively modest increase. But if you look at it in the investment world as well, you've got people who've got portfolios that are generating interest dividends, and obviously those rates are going to be going up as well. So people need to be looking at things like ISAs. I know we have the issues with pensions, looking to hold income producing assets within particular tax wrappers. You can use things like offshore bonds or onshore bonds, and actually putting the higher interest yield in those assets, and then the growth assets are probably held outside of tax wrappers if you have to do that from a structure point of view. And it was mentioned before about the bond market. Gilts are quite a valid way for people to invest. We've got a lot of people doing that instead of cash, because relatively small interest on there, and a lot of the capital appreciation you get when the gilt returns to par is actually tax-free as well. So it's just looking at different options, different structures, in terms of how, I guess, from a tax wrapper point of view, how they're held, and obviously from a business owner point of view, yes, it's gone up, but I guess it's nothing. At the marginal rates for quite a lot of those business owners are still far less than the average person pays.
And whilst we're sort of on the subject, I think this is a question possibly for Holly. So withdrawal of profits in the debate of salary versus dividends, is it now generally better to take salary as dividends are now taxed at a higher rate?
I can answer that one.
I was going to say,
Oh, sorry.
Jeremy's got the answer on that one because he ran the numbers.
So the situation is, even though Marcus rightly referenced the 2% increase in the basic rates from 8.75 to 10.75%, if most of the distribution goes to basic raters, you would probably still be better off through dividends. I think the figure work would work through that. It's a much narrower margin in terms of higher raters, and with the additional raters, you're probably better off with salary. It's very close. There are a lot of moving parts in there. You have to look at the £10,500 employment allowance that you can get against employer NIC. You've got to look at the other elements that people are earning, and there's no shortcut. You've got to go through the figures each time. But whereas it used to be a pretty automatic situation, you'd pay up to salary up to the personal allowance, and then you'd pay divs thereafter. That is not so much the case. Remember that although dividend rates are still less than employment income rates, you pay national insurance, and the employer pays national insurance on salary, which they don't do on dividends. So there's a number of swings and roundabouts. And the other element that you need to take into account, let's say I was a sole trader thinking, should I incorporate? It's the cost of incorporating, the cost of complying with all those rules is now so much that you really need to take that into account, because running a sole trader business is, from an administrative point of view, a lot simpler. And unless, so you've got to look at a number of factors. So it's not fair to say it's just for sure run it as a sole business, or just for sure run it through a company. And it's not clear always on the salary points because there are so many different moving parts. So you need to find an accountant with a computer program who'll run you through your figures on that basis. But the general rule of thumb is if you're basic rater, better to get a dividend. If you're a higher additional rater, higher raters, very close, additional raters, probably salary is better.
Interesting. And obviously there's the risks that come with trading as a sole trader, but all goes horribly wrong with my insolvency hat on. Limited companies obviously gives you greater protection with that wrapper.
The only point I would say, Kelly, to that is that so many companies where you're a director, you sign off on bank guarantees.
Yeah.
You got, HMRC is a lot keener on putting in personal liability notices for taxes unpaid, particularly VAT or national insurance, where or pay as you earn, where you're holding the money as agent for HMRC. So I do think that a lot of people think about the protection, but my view would be, and of course, trading whilst insolvent, you lose your protection as well. So
Yeah.
you may be in a better position to judge than me. But I would say that a lot of the protections that company directors think they have might disappear on a messy liquidation. But you're in a better position than me to look at.
No, you are right, Joe. I mean, all the business failures we're seeing at the moment, there's so much debt that's got personal guarantees on it. I think people have taken out funding with various lenders through desperation and haven't perhaps appreciated they've signed a personal guarantee. And you're right, there has been an uptake in personal liability notices that have been issued by HMRC as well, which is interesting. So I actually looked at the stats on that out of curiosity while we're sort of in this area. And the amount of tax that's owed to HMRC today, do you have any idea? Should I take a guess? It's staggering. No? £42 billion is owed to HMRC today in respect of unpaid tax. And pre-COVID, it was ranging between 15 and 17 billion. So we are like more than double of the amount of tax owed to HMRC compared to what it was pre-COVID, which was actually quite an interesting and horrifying statistic, I thought, when I looked at it earlier. So we've got a question from Malcolm whilst we're still on dividends. It's more of an opinion, I think, is do you agree that dividend tax is unfair to pensioners who do not pay any NIC? Don't know who would like to take that one.
It's a question, I think, of balance on that basis, Malcolm. They could have been stung a lot harder. They could have extended NIC at the moment. When you get past the state pension age, generally, no, you're in category C, so no national insurance, which is reasonable because you don't accrue any more pension. But we're in this sort of difficult stage of working out what NIC is for and who should pay it. And I would say if that is the only change which hits pensioners, then they've come off lightly. And I think you'd have to look at it in the round in terms of the triple lock still being there, certain other advantages still being there. And I think that I would say that holistically, pensioners have not done as badly as maybe certain of the think tanks like Resolution Foundation would have had in store for them if they'd carried out their full proposals. So yes, it's not great, but I think it could have been a lot worse.
No. Just finishing off from what Edward's just said, if you have a limited company, you should know your personal liability if you sign as you've signed the personal guarantee. I completely agree with you, Edward, but you would be astonished how many people see me on a daily basis who have no idea they've signed a personal guarantee because they haven't read the paperwork correctly, which is another subject for a whole different webinar, I think. So we probably should move on and look at sort of capital gains tax now. So we obviously do a lot of advisory work on capital gains tax. What sort of probably a question for Ian? What are you seeing will be the impact of the capital gains changes on personal and business arrangements?
Well, most of the changes were announced last year in terms of changes to the business asset disposal relief rate of going from 10 to 14 and then to 18% from next year. So, and on the first million of gains. So, we have seen over the last 12 months, particularly businesses with perhaps a number of shareholders who are in that band really actively considering whether they would get on with the sale and save themselves the money. Okay, 40%, £40,000 and £80,000 saving between those two sets of rates on £1 million is quite a substantial amount of money. If £1 million is your lifetime gain, perhaps from a lifetime of investment in a business. I think the biggest challenge is around those EOTs that was referenced both by Marcus and by Jeremy there. And we have seen EOTs. Myself and Holly have done many of these because they've become a useful tool for business owners as an exit plan. I mean, the point around EOTs is twofold, really. One is it's a very attractive incentive tool to staff, and I think what is interesting is the interaction of the EMI increases that effectively counterweight the negative impact against EOTs with an improvement in EMIs. So it'd be interesting to see if that changes incentive planning for business owners. But of course, the big part was that EOTs essentially were CGT free, and now they are only half free. And I think this very much depends whether you operate as a glass half empty or a glass half full type of individual, because you could look at it and say, well, that's going to cost me an extra X, i.e., 50%, in terms of what I was going to pay before last Wednesday. Or you could look at it and say, well, I'll still get a 50% discount compared to if I was to sell to an external third party outside of an EOT structure. And I think it's fair to say there'll be a mixture of people either way. They are still quite an attractive tool. They have very stringent rules around them that you have to follow. And Holly has guided many clients through that. They're not for everybody. But I think there are people who will find that a real they were going to use that as an exit tool, and perhaps now will reconsider that. The trouble is these taxes are not going to go down. No, I do not see that a future government will reduce CGT below 24%. I don't see that somebody will say, oh, do you know what, we'll put the EOTs back to 100% tax relief. So I suspect they're here to stay. So if you want to use them, you might as well get on, because one thing is for certain, this government has sort of made it clear that they're going to go more for wealth than for income, and
Yeah.
CGT is, of course, a wealth-based tax.
Can I just
Have
add
you
a
got
couple
anything?
of points?
Yeah, sure.
Yeah, I mean, last year, I think the industry welcomed the tightening up
Yes.
of the rules, generally speaking. They'd suggested them and felt that actually HMRC were behind the curve. And the tightening up of the rules was so that people, it was protecting the good from the bad. In other words, that the whole regime was getting into disrepute because people were using it basically as just a CGT tool and trying to keep control of the companies. And there are a lot of abuses around. What I find disappointing is that they haven't waited to see how this works out. They've cut the relief to 50%. They've justified it on the basis that actually, in the terms of the tax relief, cost on this basis is a lot higher than they originally intended back in 2014. But I think that it is disappointing that they've not waited to see whether this actually works better. The other element I would mention is that one of the reasons they brought in the CGT relief, and remember that at one point with entrepreneurs relief at 10 million, you were only talking about you were talking about 10% playing nothing for a number of companies in terms of the relief. One of the reasons that they brought in the relief was because if you sold to an EOT, you'd probably get a lesser price than if you sold to a competitor who'd swallow it up. And that would affect valuations. Well, that was the idea, one of the points about giving the relief. So I think I agree, it's probably not going to come back again. If you're going to go to the EOT route, you might as well carry on and do it if that's what you want to do. And there are very good non-tax reasons as well as tax reasons to do it. I think about CGT, I'm not so sure that a subsequent government, because CGT in itself does not raise a fortune compared to other elements, it wouldn't surprise me if there's some sort of study which then says actually 20% CGT would raise us more money, and would be better for economic activity, and they reduced it again. I could see it being, looking for where the sweet spot is for tax. If you follow the Laffer curve basis, might be at a lower figure than 24%. But it's not going to be unless and until there was a change of government, I don't think.
Okay,
Ian?
thanks. That's good. Thanks, Jeremy. Holly, is there anything else you want to add on the EOT side of things, or have Ian and Jeremy covered most points?
I think they've covered most of them, but I think, like Ian says, it's that sort of glass half empty, glass half full thing. I was actually at the employee ownership conference when the change was announced, so there was quite a bit of chickens fluttering around. But as someone said, if they've just announced that EOTs were going to only have a 12% tax rate as opposed to a 24% tax rate, you'd have stampedes of people heading for EOT. So we do have to bear in mind that, as well as the other advantages, and there are, I never say people should do this for tax only. It is still a really attractive tax rate compared to what you get elsewhere. So just
all about the messaging, isn't it? Yeah. Thanks, Holly. So probably like the question from Mike is probably going back more to the sort of dividend and the taxing on the businesses. So is there an argument now to operate through an LLP, or can you see the rumoured pre-November 25 budget coming into the next budget, which is when they were talking about putting a tax, weren't they, sort of corporation sort of tax style tax, was it, on LLP businesses?
I would say, having said that, sort of rumours, what they floated last time and didn't do last time, so quite a few of those changes they've done this time, there is quite a possibility that they will do it next time. However, I think part of the pushback was people saying, well, you'll drive business away. It's a lot of it services, so it's very flexible and can move. And so I'm not sure. I think that an LLP has other advantages as well, the flexibility, the transparency, and so on. So I don't think that the tax tail should always wag the commercial dog. But if you think that an LLP is the way to go and is suitable for your business, and that's always I think the most important thing as a tax person, I still always say, look at the commercials first, then look at the tax. But if that's the way, I see no reason why you shouldn't consider doing an LLP.
Okay, thanks, Jeremy. So probably need to cover pensions, Marcus. So, there's obviously the issues with regard to salary sacrifice that are now sort of being implemented, but what's the most significant part of that's come out of the budget this year in terms of pensions for you?
I guess pre-budget we had a blind panic on people taking tax-free cash out. That was one major issue. We had that last year as well. Billions and billions generally was taken out of pension funds, and I guess there was a combination of things there. One, it was, they were going to change the rules or reduce it. Secondly, some people, it had been in the press about the gifting rule, so you can gift assets away if you live 7 years, and that's currently, or it still is, uncapped. And some clients had read in the newspapers as that might be going to 10 years, it may be capped. So then we had a panic on the pension front regards to people taking money out, which obviously I did say to quite a lot of clients. I think someone said to me it'd be political suicide if they changed tax-free cash, and obviously they haven't done that. So I guess the biggest thing that we knew anyway was that pensions are still going to be in your estate from April 2027, so that's not changed. I guess positive is there's no change to funding, so the annual allowance, how you can draw benefits, that's all stayed the same. And yes, salary sacrifice was. We had a bit of noise about that 2 to 3 weeks before, and then obviously that's coming in from April 2029. And it's not a specific area I advise on. We've got a specific employee benefits team, but I was talking to the guy that heads that up this morning, and I think for employers, yes, there's a big change on the NI and the NI for the employee and the employer, and also on the employee as well paying in. But actually, businesses have still got another 2 and a bit years to implement these schemes to actually benefit from those changes if they haven't already done so. So there's still action that can be taken, and obviously, I guess in the coming year or so, I'm sure people will be looking for ways around this or other planning opportunities or sort of what they can do. But oddly, I think a lot of the panic, I guess, was on the personal side in terms of rules, regulations, changes. Death benefits were essentially confirmed in your estate for IHT. But actually, the biggest change was actually on the salary sacrifice side, which was a bit of a surprise in the end, really.
Yeah, absolutely. That's as a question for Peter on this, who's thinking ahead already. So Peter says, can we just issue new contracts of employment reflecting a lower salary and increased employer pension contribution? Obviously, the downside of this is if it makes the change permanent, but otherwise, surely it's an easy way around the national insurance increase.
Ooh, sharp intake of breath. For that, I mean, reducing someone's salary is not something, and I think that on that basis, given that a reduction in salary has to be agreed by an employee,
Yeah.
I think that that would be a problem. The interesting element with this, which is why I think it's slightly bonkers, from a sort of a Labour point of view, is that it doesn't stop me, as far as I can see, as an owner manager of a business, shoving loads of money into my pension and getting the full tax relief on that basis, up to potentially annual allowance of £60,000. It stops the person on the shop floor by putting more than 2,000 into the pension by doing salary sacrifice. So it actually affects the ordinary person, whereas potentially the business owner, unless I've missed something that everybody else has picked up on, seems to be able to get away with this and put in as much into the pension as they like and get all the reliefs because they're controlling it. They don't need to do a salary sacrifice. The other element that I'd like to pick up of why I think the policies don't really have as much credibility is that if you work on subjecting your undrawn pension to IHT, and then the participant suffering income tax on it if you die over the age of 75, is that you can get to a rate of combined income tax IHT of over 80%. Now, this hasn't got a lot of traction at the moment, but I suspect in the run up to April 2027, it will do. And I'd have thought it would be frankly embarrassing for any government to be presiding over a marginal rate, which could be as high as 84. And in some calculations, I've seen as high as 91% on that basis. And I think that that's why I think that this particular policy may not survive a collision with reality.
Yeah.
I don't know. Marcus may have a different view.
No, I was going to say it's a very valid point because what we're already seeing clients doing is actually from a fairly logical point of view, like you say, you pay 40% IHT and then your beneficiaries pay a marginal rate on it. They're already starting to take income now, even if they don't need the income, they can gift that income away out of income and expenditure, or people are taking it and spending it and paying the tax now anyway. So yes, there is a bit of the government are getting some money back because people are taking money out and actually spending it in the economy. But actually, quite a lot of people have started to take it, give it away. They're using various IHT exemptions rather than waiting. But they're taking it at a sustainable level, so they're not trying to deplete the pot too quick or take too much because, as you correctly know, something may well change in the future. But the actual principle behind people saving for their lifetimes to then pay for them and the beneficiaries to be paying obscene rates of tax, it just doesn't add up. It's really something that's got to be looked at.
And did I read somewhere they're going to increase the age in which you can withdraw from your pension? Because isn't it you could withdraw your 25% tax-free lump sum around 55, but I think they're going to increase the age.
Yeah,
Is that correct?
it goes up and yeah, it's now 57.
Okay.
So and it's linked. I guess something you need to bear in mind is it's always been linked kind of 10 years below the state pension age, which is currently 67 now. Obviously, if the
Yeah.
state pension age starts to tick up, concern then is the age at which people can take benefits then starts to tick up as well. So yeah, it's currently 57. There are certain schemes, certain employment types, like sports people, for example, can often take it at an earlier age. But yeah, so it's 57. So, but again, that link to the state pension age, which, as we know, is going up by 4.8% next year
Yeah.
again, another big hike. And if you look at it from a wider tax point of view, is that the state pension from next year, if you're on the full state pension, is only £22 within your personal allowance. So
Yes.
a prime example of that, keeping the allowances low, and then suddenly the year after that, anyone on a full state pension is automatically dragged into 20% tax, even if they haven't got any other income.
Seems bonkers, absolutely bonkers. And obviously discouraging people to save in their pensions clearly doesn't have a longer term impact on, state pension reliance in the future. So
Yeah.
I mean, that is the point here. So Marcus referenced the fact, how long will these changes last? You can see how coming up to the next election, you could choose a number of these things to change, and the overall effect on the public finances would be small because these are so small sport of changes. They aren't big ones. So you're getting a lot of pain and hassle for not a lot of revenue. And therefore, you could construct something relatively popular and relatively cheap that would reverse quite a lot of these things. And that's why, she didn't go for the big 2 or 3p increase in income tax and then spend that money, which would be much more difficult to change. But I do wonder about the small things which really irritate people, but don't actually raise a lot of money.
Yeah.
Interesting tactics. Right, I think we're sort of running to time now. So thank you, Jeremy. That was very insightful and very and hugely helpful. Thank you to Holly, Ian, and Marcus for your comments as well. We'll be putting some contact details on the screen, I believe. Should you wish to get in touch with anyone, I think we have answered most of the questions. There's a couple of things about mansion tax we didn't get round to, but if you want to contact any of us directly, then please feel free. Before I go, there is a final CPD webinar for 2025, which is on Friday and covers year-end tax planning. Always a popular session, and probably more popular now following the budget and the upcoming changes. So Jeremy will be joining us again on Friday to help us with that webinar. We like to keep him busy. You can find further details and a registration link on the webinars on the K3 Hub website page. Again, the website address is on the screen, but if you want any more help with that, then please be in touch. So I hope you enjoyed the session. Thank you all for joining us. We've had a great turnout, and I wish you a great rest of the week. Thank you.